In this section, we're diving into descriptive analysis and its purpose in the retail business. Ophelia, can you tell us how descriptive analysis works?
Sure, Rana. Descriptive analysis is all about understanding what happened in the past. It takes data we already have, like sales figures and external factors like temperature, and helps businesses see patterns and trends. By analyzing this historical data, businesses can gain insights into why certain products sold well or why sales dropped at specific times.
In retail, these insights are incredibly useful. By looking at past sales, businesses can adjust their strategies, plan better for the future, and make smarter decisions. Let's look at our graph here, which shows the relationship between sales and temperature.
As you can see, the graph displays monthly sales data for each product category, overlaid with the average temperature for each month. The red line represents the temperature, and the colored lines show the sales trends for each category.
So, for example, when the temperature drops in the colder months, what do we see with sweater sales, Ophelia?
Great question! Sweaters show a clear spike in sales starting around October, when the temperature begins to drop. Sales continue to stay high through the winter months, and as the temperature rises again, sweater sales start to decline during the summer.
And it's not just sweaters, right? We see similar trends with jackets.
Exactly. Jacket sales rise during the colder months, similar to sweaters, and then drop off when the weather warms up.
Now, what about shirts and pants? Their trends seem to be a bit more stable.
Yes, shirt sales remain steady throughout the year, though we see a slight decrease in colder months as people switch to warmer clothing. Pants sales also don't fluctuate much with the temperature, but there is a slight increase in the winter as people tend to wear more pants during colder months.
And lastly, we have accessories. How do accessories like scarves and gloves behave with temperature changes?
Accessories see increased sales during the colder months, especially for items like scarves and gloves. However, overall sales in this category remain relatively stable throughout the year compared to other categories.
So, Ophelia, why is descriptive analysis so important for retail businesses?
Descriptive analysis helps businesses understand why things happened. By analyzing this data, they can see what drives sales for specific products and make informed decisions about inventory, promotions, and even staffing. For example, a retailer might realize they need to stock more jackets and sweaters when colder months approach, based on these patterns.
Now, let's turn it over to you. Looking at this graph, what other types of information can we gain?
For instance, do you think we could use this data to plan marketing campaigns? If we know sweater sales increase in winter, could we run a promotion around this time to boost sales even more?
Or what about bundling products together? Could we offer scarves and gloves with high-selling items like jackets during winter months?
And think about the broader business strategies. How might this analysis help in planning for staffing? If sales increase in colder months, wouldn't it make sense to schedule more staff during these peak times?
Lastly, how could this type of analysis help us avoid overstocking? If we know certain items sell better in specific months, we can adjust inventory levels and prevent unnecessary costs.
Exactly. Descriptive analysis isn't just about understanding the past. It helps businesses plan for the future based on real patterns and data.
So, what insights do you think you could gain from analyzing historical data like this? We'd love to hear your thoughts.
Thanks for joining us in this exploration of descriptive analysis. We'll see you next time for more insights into how AI is transforming retail and other industries.